Hello friends, this is Singh, broker owner of Supermax Realty, 647-961-2639, or you can reach my website www.supermaxrealty.ca. So friends, in the morning, one of my friends and my past clients, he called me and he is relocating to Alberta, and he intend to keep the property as rental for a couple of years. So he just called and asked me the tax implications. And obviously, if you watch my videos, I always tell everybody I'm real estate professional. I'm not a tax accountant or a lawyer. So if you need legal opinion or tax advice, you should seek from experienced, knowledgeable accountant and lawyers. But I will share my thoughts. So I told him, a taxpayer can only designate one property as a primary residence. It can be your house or a cottage during a one tax season. So that is very, very important. And if you sell your property, primary residence, even what you call, you still have to file since 2016 Schedule 3 when you file taxes with the accountant and you designate your property that you don't have to pay the tax, capital gains, and it's called primary resident exemption. So that is something you apply with your accountant when you file taxes, and you don't owe any taxes. But there are some cases I have heard in last couple of years where CRA is coming aggressively after the flippers. So CRA is cracking down on the abuse done by some of the people using their house as a primary residence and using the exemption to save on paying taxes. So what they're trying to basically tell people not to do is, you can't use a house like move in house 1 year, sell it, move next year, make money, sell it, then move another year. So they watch you. So if you've been doing for last couple of years thinking you are getting away with it, but friends, watch out for it. I have lot of clients who work with CRA, and they always tell me they have a special department and they see real estate investors as a low hanging fruit. For the past couple of years, I do a lot of pre-construction homes and condos for my clients, and a lot of builders tell me that they receive letters if somebody is trying to flip or assign. So CRA taxman is watching you, so be very, very careful. And obviously they want to make sure if you keep flipping properties every year, you move, fix, flip, next year again book a house, move, and in the last 6-7 years you change like 4, 5, 6 houses. There has to be a reason behind it. What they're doing is they're not even giving you 50% capital gain exemption. They're counting profit as 100% taxable income, right? There's a lot of cases going on there. And what happened is, one of the clients, I think 6-7 years ago, he called me, moved to Alberta. He's also working for oil company. So he lived in the house, let's say for example, September 30th, 2013 up to 2018. And then he rented a couple of years. But during those years, he just rented house in Alberta. When he came back, he moved to his house in Mississauga. And then obviously he filed the taxes accordingly, telling the truth to the CRA. So instead, this is what I tell my clients: when you change that, your designated primary residence to an income property, as soon as you move out and you have no intentions of selling and you think you're going to move to a brand new house, call an appraisal, get an appraisal done on your property. So that way, when you sell the property and CRA challenges you, you can show appraisal report. Because in court of law, real estate evaluation doesn't hold. So you need a professional appraisal to do those things, and you are fine. And what they also want to see is that exemption. They are even flexible. There is section in subsection 45 C, you can 45(2), when you do CRA audits and stuff. So they say even during all those 4 years where that person is not living there, they still considered as a primary resident. And the only thing is, you have to be in Canada. You have to be resident of Canada. That is very, very important. You can't simply come from India, Hong Kong, buy a house, move to China, and then basically claim as a primary resident, right? And for a primary residence, it has to be inhabitable by taxpayer, their spouse, common law partner, or their kids, or maybe their former spouse or common law, if they're, divorced and stuff like that. And the primary residence can be a detached, obviously, cottage, mobile home, trailer, apartment, cooperative, and then, houseboats as well, right? It can be joint ownership, or you can be a sole owner, right? And if you buy and sell house within the same year, yes, you have two residents, but CRA is fine with that. So the main thing is, what people look for is, the CRA look for is, what is your intention when the case goes to court. You have to hire obviously a lawyer to fight CRA. They want to see how long you lived, or what is the length of your ownership of your primary residence, and how frequently you do these transactions. Are you a flipper, or what is your business? Let's say I'm a real estate agent. Personally, I like to live in a house for long term. I do investments, but I don't like moving every year. It's too inconvenient for my lifestyle. And they see the frequency of transaction and what you do for a living. So if you're a contractor buying houses in Hamilton, London, fix it, move inside, and then after 9 months or 1 year just sell it, just to bypass the laws, the karma will catch you. And when they catch you, you have to hire a lawyer, fight in the court. You might win, you might not win. They want to see your motive and circumstances regarding your sale. You can't make excuses. Maybe one time you didn't like the neighborhood, you find it's too noisy, your house is close to the highway, maybe power line, whatever, you know what I mean. One time is fine, two time is fine, but you can't keep doing again and again. It has challenges. And generally, CRA prohibits is prohibited from reassessing any individual taxpayer more than 3 years after the original assessment. But unless it can be proved that the taxpayer has made false statement, and they can attribute all these misrepresentations because of their carelessness or neglect. Because everybody know what is right. We know the person who's buying and selling, they know, they have an accountant and lawyer. So those things, guys, very, very careful. And if you have any further question, I always tell, talk to a knowledgeable accountant. If you're in doubt, get a second opinion. Talk to your lawyer, tax accountant who specialize in real estate sales field. And other thing is, let's say sometimes people buy a bigger land with the house, and there's another subsection you can check with your accountant. Somebody told me many years ago, they said land in excess of 1/2 hectare. You can't consider the extra land as your primary residence and get an exemption of not paying taxes. It means, let's say if you have a house plus 1/2 hectare land on it, it will qualify as a primary residence. You don't have to pay. You have to sometime prove to CRA the excess land, which is also part of the property, is necessary for your own primary use and enjoyment. Because you have to prove that the land cannot be severable. You can't cut the land and sell to somebody else, right? So if you just buy a land, in some of the videos I tell you, if you're looking to buy a land, there's HST component as well. So CRA is always auditing, doing these things. So when you buy a big piece of land with the house on it, you have to be careful when you sell the house. Talk to your accountant. Is all this land basically as a primary resident tax exempt? And check out the 1/2 hectare law if you're living in a bigger rural area or outside GTA, Golden Horseshoe boundaries. There might be some tax implications. Again, guys, thanks for watching the video. And if you haven't subscribed to my channel yet, go to Real Estate Edge with Jimmy Singh. Leave a comment, and if you want any topic for me to discuss in my coming videos, kindly leave your comments. I appreciate that. And I'll see you soon. Thanks for watching. God bless you.